Credit utilization ratio is a crucial factor that lenders consider when assessing an individual's creditworthiness. It is the ratio of the amount of credit used by a borrower to the amount of credit available to them. In India, it is an important parameter that affects one's credit score, which, in turn, impacts their ability to get approved for credit in the future. In this article, we will discuss what credit utilization ratio is and how to manage it in India. What is a credit utilization ratio? Credit utilization ratio is the percentage of the available credit that a borrower has used. It is calculated by dividing the total outstanding balance on all credit accounts by the total credit limit. For example, if a borrower has a credit limit of 50,000 rupees and has used 25,000 rupees, their credit utilization ratio is 50%. Lenders consider credit utilization ratio as a measure of how responsibly an individual uses credit. A high credit utilization ratio indicates that a borrower is using a significant portion of their available credit, which may suggest that they are over-reliant on credit or may be facing financial difficulties. A low credit utilization ratio, on the other hand, indicates that a borrower is using credit responsibly and is likely to be a low-risk borrower. How to manage credit utilization ratio in India? Maintain a low credit utilization ratio. As mentioned earlier, a low credit utilization ratio is desirable. Ideally, one should aim to keep their credit utilization ratio below 30%. This means that if the total credit limit across all credit accounts is 1 lakh rupees, the outstanding balance should not exceed 30,000 rupees. This indicates to lenders that you are a responsible borrower who does not overuse credit. Increase credit limit. If your credit utilization ratio is high, one way to lower it is to increase your credit limit. This can be done by requesting a credit limit increase from your credit card issuer or by applying for a new credit card. However, it is important to note that this strategy can backfire if you end up using the additional credit and increasing your credit utilization ratio further. Pay credit card bills in full and on time. Late payments or missed payments on credit card bills not only attract high interest charges but can also negatively impact your credit utilization ratio. Therefore, it is important to pay credit card bills in full and on time. This not only helps you avoid late payment fees and interest charges, but also shows lenders that you are a responsible borrower. Monitor credit utilization ratio. It is important to monitor your credit utilization ratio regularly. This can be done by checking your credit report, which is available for free once a year from each credit bureau in India. Monitoring your credit utilization ratio can help you identify if it is increasing and take corrective measures in time. In conclusion, credit utilization ratio is an important factor that lenders consider when assessing an individual's creditworthiness. Maintaining a low credit utilization ratio can help you build and maintain a good credit score, which is essential for accessing credit in the future. By following the above tips, you can manage your credit utilization ratio effectively and use credit responsibly.